Connaissance,
recherche,
sciences,
des sciences,
mathématiques,
théorie,
physique,
philosophie,
conférences,
archéologie,
nature.
Bonjour. Aujourd'hui, nous allons parler de...
Well, good afternoon. Today we are going to be talking about access to credit and financial services. So back in the 70s, there was a tremendous effort from the part of a number of governments and countries to lend money to the poor. Access to money was a way to guarantee an enrichment of all. So there was a number of programs in a number of countries of leading to access to financial services. Then, subsequently, government gradually left out the programs for lending to the poor. These programs collapsed, leading to, in many cases, failures and financial failures. So these programs were almost like functioning like benefits or similar schemes. Although they were presented like credits, there was very little hope of actually getting one's money back. As an example, in India, with the nationalization of banks back in the at the end of the 70s, early 80s, there was a strong development of banking agencies in rural areas. And Robin Burgess and Rohini Banda's studies showed that these agencies actually allowed to cut down poverty and to increase people's income by $1. Thanks to this system of agencies, actually cost almost $3. Basically, people get richer, but it is more expensive. It is a more expensive scheme for governments. What was shown in India and in other countries, amongst which Brazil, that these loans, because they were very often not paid back, they were regarded as a very precious tool. And they were very often taken over by the richer part of the population, as opposed to the poor, and used for political influence building purposes. And studies showed that when credit increased by 5 or 10% in agricultural land, and in particular in districts where elections are very tight, very much in the balance, and therefore these credits are not that productive, such as they're used by political or as political tools. So these are simply examples that reflect or used to reflect a general trend, and international institutions such as the World Bank and the International Monetary Fund really started working on or reviewing what the situation was in terms of lending to the poor. But they always are informal institutions for credits. The level of villages and systems of group loans, whereby people actually lend each other's money, and so they can actually get back. It's like a kitty or a tontine scheme, or transfers and donations made to neighbors, as an example. So all these informal systems haven't got the benefits of like constraints of legal litigations. They don't resort to courts of justice for their settlements and so on. So maybe that lead us to think that they could be more sort of better organized. And this led to the revolution of microfinance. And officially, it started back in 1976, when Mohammed Yunus, professor of economy in Bangladesh, started the Grameen Bank. And I will tell you a bit more about this scheme later on. But this was about lending money to poor women. So it started off with about 10 women, and from this very modest and unassuming start, this has become a worldwide scheme with about $25 billion of money being exchanged, 100 to 200 million clients, and a high repayment rate. So what needs to be borne in mind is that most of these institutions have a non-profit making scheme, so but they are viable, so they don't actually need any funding or subsidies to actually survive. So the microcredit has become a major phenomenon. It was rewarded back in 2006 by the Nobel Peace Prize, awarded jointly to the Mohammed Yunus and the Grameen Banks, i.e. all the women clients to the clients of the bank. So obviously there was an academic and institutional recognition here. From the point of view of the investors, the microcredit was very well recognized. And the most recent example is the public buyout scheme of Compartamos, microfinance institutions based in Mexico. And that was up for public tenders. So there was a recognition by the Nobel Prize, and from a business perspective, rewarded by the actual takeover of Compartamos. We will come back to the actual tensions between these two objectives. Today, the microcredit institutions try to become institutions of microfinancing. So the IMF, as it's made reference here, and they try to provide other financial services beyond the actual loan-related schemes, the basic products. More individual loans are more significant in greater numbers for micro enterprises, households, savings schemes, and the next step up is the insurance services. So what we're going to do today is that we're going to take a step back. We're going to take stock of what has been going on in microcredit and microfinancing revolution, trying to see and understand why lending money to the poor can be a way to exclude the poor and the most deprived part of the population. So we are going to look into this in more sort of, we're going to take a step back, and then we're going to try to see in practical terms whether these constraints are actually important, significant in the field in practical terms, and whether these constraints are actual constraints. And this will allow us to actually shed light on the revolution of microfinancing that was brought about in order to tackle these constraints. And we're going to try and address the real constraints of microcredits. And we're going to look into, on a mechanism basis, up to what point each of these innovations are responsible for the capacity of microfinancing in order to lend money and get repaid. And then we will look into what microcredit stands for and how it can be put in place. We have fewer data in this. I would say we are just its early stages in this matters yet. And as microfinancing institutions demonstrated, will tackle the pure credit, or will go beyond the pure credit side of things, and will tackle savings and insurance. So we'll be looking into further services. So let's take a step back and think and look into the obstacles in terms of accessing credits in the marketplace. So two types of obstacles are being put forward. Generally speaking, what we call the moral alea in the anti-selection. And because of these two obstacles, we'll see that lending to the poor can be expensive because so in order to be profitable, we require higher interest rates. And another constraint that was put forward by the governments before they take over of microcredit schemes is that the projects, in order to offer interest rates, in order to lend the poor money in a profitable way, it wouldn't make the actual projects viable to start with. So it's not possible to lend money out to the poor without subsidizing these money being at stake. So we'll look into this in more details. Let's start off with the moral unknown quantity in order to translate this in clear terms. Is that, are you going to run away with the money I'm going to lend you? So let's say you want to get started with the project. You need K number of euros, and once you get your project completed, you're supposed to be getting money in excess of K euros, so i.e. W. So K minus W if you need to repay this initial sum of money. So if you buy a house, okay, you need to pay 100,000 euros, but you need to repay 200,000 euros. So times 1 plus the interest rate. So this is what you'll be doing if you repay. But let's imagine that you also have the opportunity to run away with money by paying a fee. Like you can, if you want to build villas on the Riviera, it's not the best way of using money for yourself, but it's a way to run away without repaying. So it will cost you a bit of money. So N times K. So if the cost of running away with money is lesser than the cost of not running away, so you won't actually be running away. So the if you can get more mortgage, the more mortgage you can get, less tempted you will be to actually run away with money. So hence, the more money you can take as mortgage, the more chances are, or more likely you will be to actually. I mean, banks will not be willing to provide you with a sufficient amount of money for you to run away with money. And so, according to this particular scheme, you can only take, or you can only be granted up to a certain sum of money, so times 4. If you wanted, for instance, to take out a loan on a house, then you will be required to put up or to pay a lump sum as a guarantee, as a deposit for your house, as a contribution to the repayment of the capital. It doesn't mean that you're completely cut off from the credit market if you're belong to the poor part of the population, but it means that the sum of money will be lesser. So let's see, I mean, the first constraint is that you will be limited up to a certain sum of money. And this first constraint leads you to a second one, i.e., is that the bank, in order to prevent you to run away without repaying, will charge you for surveillance costs. So if there isn't any cost for controlling money, this will not work. So for each lump sum you will be getting from the bank as a loan, you will need to pay an extra charge. So basically the bank if you open up an account, you need your own account. Even if this account has got 1,000 euros or 100,000 euros on it, you will still need this fixed cost. This fixed cost is not proportionate, it's a fixed cost. So to work things out, let's say lending €1 costs the same amount of money to the bank as lending 1 million euros. Let's take this as a borderline case as an example, and then the logic will be applied perfectly in terms of regardless whether the cost is fixed or proportionate. So then there is a multiplying effect. To cover these fixed costs of control, the bank needs to set up higher interest rates. But by doing so, as we've seen in a previous example, the temptation of actually running away without repaying money is getting greater. So therefore, interest rates need to be reviewed upwards in order to cover the default or the risk of running away. So there's two risks involved here. There can be a very high cost between the cost of money to the bank in terms of its interbanking interest rates, and the interest rates that will be put forward to its clients. Even a small control cost can be demultiplied by this effect, i.e., I'm going to increase the interest rates in order to cover the actual lump sum being lended, and then the fixed charge will be increased. So there's a control cost involved here. The second consequence is that it may well be that there isn't any interest rates that allows the bank to actually get its money back. So basically, the interest rate goes up, as the control cost goes up, the interest rate goes up in terms of limiting the temptation of running away with money. And what happens in this case, there isn't any possibility to actually grant loans. So, and then your personal wealth is weaker, is lesser. So the second credit-related contents, which is more serious, i.e. you can end up being completely cut off from the credit opportunities, from the credit market. It may well be possible that the bank turns down all applications for mortgages, for lending or applying for loans. So in clear terms, the cost of controls are sufficiently high in order to verify what's happening on a very small loan can end up being too high for the bank, as in the case of microcredits. Furthermore, even if this situation doesn't actually happen in reality, in its unfair way, the poor need to pay higher interest rates than the richer part of the population, because there's a higher chances that they will be running away with money. So basically, the more, in that case, the more money you take out as a loan, the less an interest rate will be. And if you're poor, you can be completely cut off from the lending market. So this is the first type of problems that explains that it may well be particularly difficult to lend money to the poor, and that it can be very difficult that the poor have got to bear or have got to pay a high interest rate, or can be completely cut off from the credit market. That can lead to a failure. Besides, in terms of what can be reflected, is what we call adverse selection or anti-selection. So let's imagine that interests are divergent. So in terms of people being able to, or chances of people more likely than others to run away with money, let's imagine that this is something the bank cannot observe as such, that cannot see as such. So in this, according to this model, some people will take loans without any intention to actually repay the money. So they just have the basic intention, regardless of interest rate, have the intent of running away with the money. So as a result, the banks will need to increase their interest rate to cover their loss, and they will actually discourage the best clients, because basically for those who want to run away with money, it's basically regardless of the interest rates. So therefore, the banks need to increase even further the interest rates in order to cover for their cost. And then this leads to the fact that there may not be any interest rates that allows to cover the cost of loans, and some people are not in a position to put forward any assets to be used as securities or guarantees, and therefore people will be and the poor will be cut off from the market. Another characteristics of this type of markets is that even if in the beginning there's a strong competition between banks, in this type of environment, there's lesser ex post competition, because once we've conducted a vetting process, checking out who you are, in order to get you in signed up with a bank, this will create a loyalty phenomenon, and once when banking institutions understood that you basically decide to change banks, you will be regarded as a bad client. So this will create a dependency situation between the the banking institutions and the customer. Once the situation of dependency exists, the bank can actually ask for higher interest rates to be paid out without any risk for its clients, because for these particular clients, it will be extremely difficult to change banks. And this is actually this is in the case of people in local villages applying overrated interest rates. So basically village usurers. So because obviously the banks will need to check who their clients is, and basically these local usurers coming in will actually make people dependent. So if morals and anti-selections are real or actual constraints, the credit market can lead to a poverty trap, not only at the level of individual, but also at the level of society. Because I can't have access to credit markets, although I can have some form of activity to start off, I will not be able to start off my activities, my economic activities, and I will remain in poverty. And at the level of society, because institutions that can allow a better functioning of credit market, like credit bureaus or agencies with a court of justice in operations, a proper policing services, can actually avoid the moral unknown quantities and the anti-selections. So if such systems do not work properly, society will remain in the state of poverty. So what is the reality of these constraints in practical terms? We're going to put forward a number of questions. Firstly, because of the constraints I was talking about, interest rates of the market can be higher for the poor as opposed to the less deprived part of the populations, and then are they so high that the actual profitability of schemes is just not enough, is not going to cut it to make projects actually viable. So, secondly, our high interest rates increase anti-selection related issues. Do they increase the temptations of actually running away with the money? And is there a moral unknown quantity on the credit market? So, and then we are now going to look into empiric and experimental studies in order to demonstrate these principles.
So, high interest rates, we don't need to carry out any experiment for that. We just need to look at what's going on in the market. Interest rates are very high and extremely viable. In Pakistan village, interest rates with usurers can vary from 2% to 150%, sometimes in the same village. Second thing, and this is suggested by all data we have available, the poor take smaller loans and pay higher interest rates than the richest. And the interest rates paid by the poorest are extremely high. One extreme example, and we'll come back on that, the day-to-day interest rates for fruit and vegetable for small groceries in India are of 20% per, or of 5% per day. So that's a huge rate in terms of interest rates, and 3 to 4% interest rates per month are quite usual. So that's quite a lot. So interest rates are high, and the poor pay higher interest rates than the rich. And I mentioned that, but microcredit interest rates as practiced by microcredit institutions are also very high, not 3 to 4% per month, but very often 20 to 30% per year. So does it mean that because of such high interest rates, rich people are excluded from the credit market because their profit cannot be above the interest rates they have to pay? Well, apparently that doesn't seem to be the case, because we see these rates and we do realize that poor people do borrow money at those rates. For small fruit and vegetable sellers in the market, they still borrow, and the interest rates are going very high and increasing regularly. So does it have an impact on the profitability of their project? The answer, we might be tempted to say maybe not. But on the informal market, it shows that the poor are capable of borrowing at these rates and capable of paying back. This is what Yunus observed. He said, how can we say these poor people cannot pay back when they borrow from usurers at these huge interest rates? So they need that. It means that their projects are profitable enough for them to be able to pay back. But these are the people who've decided to borrow, and now there might be a high level of heterogeneity in the projects, and maybe it's a marginal part of the people who decide and borrow at such a very high rates. And that would mean that such a very small minority of people would have profitable projects. So now what we need to do is to look at the profitability of average entrepreneurs. So there is one experiment that helped us study that, and this experiment was carried out in Sri Lanka. It's a study carried out by a researcher there working with two other fellows, Grace McKenzie and Scott Fellows. And after the tsunami, they looked at all businesses, and they selected 450 households with a small business which had not been affected by the tsunami, because tsunami impacted people had been dealt with differently. And they have a very small business with a capital expenditure below $1,000. And the cash flow in these companies was of about $100. So they asked questions to these 450 people, and to thank them for providing input in the research, they organized a lottery, and some people would get a small prize, a small bonus, a small incentive. One third would get $100 immediately, another third would get $200 immediately, and the last third would get an incentive, but after 1 year. And then they carried out regular investigations after 3 months, after 6 months, etc., to check on how this money was used and what was the impact on the profit. And the benefit of this method, as when studying people who decide to borrow, is that everybody took the money, because that was money for free, no reason for not taking it. So that allowed the researchers to study the profitability of capital on average. And what we can see is, well, this is the average profile of a business that didn't get any subsidy, then they get a subsidy, and you see that you move up from 3,850 rupees to 5,271 rupees for $100 incentive. And what's also interesting is that moving to $200 does not increase profitability. So there is a great benefit moving from nothing to 100, but then at 200, maybe the business is too small to be able to absorb such a large input of capital all at the same time. At the same time, the average monthly benefit was a 5.7%, so 5.7% in profit per month. And that would be a pretty good profitability rate for many businesses here in France, and that's higher than the interest rates I was mentioning earlier, which is usually between 3 to 4% per year. So capital yield is high enough on average to allow poor people to borrow at very high interest rates. Therefore, it seems that a large number of poor people, because even the poorest have, even those having very small businesses, have investment opportunities which are very profitable. So they're willing to borrow even at very high interest rates. Now, to look at their sensitivity to interest rates. Are they very sensitive to interest rates? Are people discouraged when interest rates increase dramatically or not? So in order to study that, because we all know that microcredit institutions are convinced that interest rates can be high because the poor people are capable of paying for these interest rates and are willing to pay for these interest rates. So interest rates can be increased, and most of the time they practice very high interest rates. One example, well, this is not a microfinance institution, but it's a consumer loan institution. It's a former microcredit institution in South Africa that turned into a consumer loans institution, and they practice highly variable interest rates, which can be as high as 12% depending on your risk profile. So Din Carmen and Jonathan Zimmerman will talk about Jim Carmen quite a lot in this class, because he is one of the researchers who worked the most on microcredit. So they both worked with this institution, and they took a list of 55 former clients, and they wrote to these clients, a bit like the bank used to do on a regular basis, and they sent a mail and offered a rate. But instead of offering the usual rate, they between 7.75 and 11.75% per year, but they made a random choice with regards to rate. So most people who had a 7.75% rate had an offer ranging between 4 and 8%. Most of the rates offered were usually below the rates people were used to. In 96% cases, the rates offered were below the rates people already had. And another aspect of these letters is that the payback period that was offered was also selected randomly. So in the letter it was written, for instance, you can borrow so much money and paid back in 1 month. The interest rate was offered, and the duration of the loan was only a suggestion. Here are the results. The number of people who accepted to take the loan based on the interest rates that was offered, standardized at 0. So 0 is if the interest rate is equal to the one you usually get. And when you go to the left, it's a lower interest rate. And more you go to when you go to the left, it's a lower interest rate. And you see the result. The slope does not decrease dramatically, except when really it becomes very high. But when the difference is not very big, people are not extremely sensitive to interest rates. And reducing the interest rate by 1% only decreases the number of subscribers by 0.3%. So moving from 5 to 4% would only decrease the number of subscribers by 1%. And this is slightly in contradiction with what microcredit institutions say when they claim that people are ready to pay very high interest rates. What we see here is that clients are sensitive to an increase in interest rates. And when you consider that these interest rates are very high already, we could imagine that they're already at the optimal level and they can't be increased any further. So people are not extremely sensitive to interest rates, but they're more sensitive to the payback duration. If you offer them to pay back in 4 months, they're less interested than if you offer them to pay back in 6 months. So if you increase by 1 month the duration, the payback duration, you get 15% more subscriptions. But let's be cautious here. Do clients really understand what an interest rate is about? When you know that microcredit institution bill a very high interest rates. And there is an institution that recently released their figures, and by which we see that the people at the origin of these projects became very wealthy, which made Yunus very angry because he said this is not going by the initial philosophy, and that these people are not any better than the usurers that he was trying to replace. And this microcredit institution was in Turkey, by the way. And their answer, that was computamos. And they said, well, if clients are willing to borrow at such high rates, then why not? I mean, nobody would force them to come to us. And if they do come to us at this rate, it means that we still have a social role because we accept to lend them money, and that attracts investors, and that's even better because then we can have a sustainable business. That's the argument of Comportamos versus that of Yunus, who says we need to engineer the lowest possible interest rates, still making sure that we are sustainable. So, Comportamos' philosophy means that clients need to understand what interest rates are about, which is not necessarily the case. In India, they would present flat interest rates, so the interest rates you will be paying on the capital that you borrow. So if you borrow 100, you'll have to pay 12% of 100 all along the year, although you pay the capital, you pay back the capital as you move on. So the actual interest rate is twice the one which is written on the document. And that's a big discussion between the Central Bank of India and microfinance institutions in India, the Central Bank accusing microcredit institution of a lack of transparency. That's one thing. The second thing is, do people understand what an interest rate is, and do they really pay attention to interest rates or to other less important things? So in order to know that, Carmen and other fellows worked with the bank or with the South African institution I was telling you about, and they tried to study how the bank would attract new customers and how they would do with their marketing policies. And the interest in all this is that they varied the interest rates, and they also modified the marketing documents, which should not have any role to play. So they compared the same amount of money and the same interest rate, but with slight modification in the marketing communication. So what can be varied? Do we put a picture here? Is it a man? Is it a woman? We can change this. Instead of saying a special rate for you, we could say a low rate for you. We can vary this as well. We could give different examples of amounts, of maturity date, and of payback amounts. We can also include a lottery to win a mobile phone, etc., etc. So we can modify, change a few things that should not be of any importance in the decision-making process. But all these manipulations do have an impact on demand. And more seriously, they have a greater impact on demand than interest rates. For instance, if you, instead of having a young man here, you have a young lady, then the number of subscription increases by 0.4%. And 1% interest rate increase has an impact of 0.3%. So something that makes no difference. I mean, the picture of a man, of a woman makes no difference, but it has a greater impact than the 1% decrease in the interest rate. Another example, we could say, well, you could use this money to buy a refrigerator. People look at it as a constraint, and if you don't give any specific example, you get an increase in the number of subscription, which is of 0.6%. So once again, you know, there are many psychological data that show that people don't like to have too many options because it becomes very complex. So offering just one date of maturity increases the number of subscriptions. So all these manipulations, which are quite benign apparently, seem to generate more impact than the decreasing in the interest rate. So that proves that we don't understand well what leads to the decision-making process when it comes to taking a loan, when we also realize that this is very important. So, are interest rates above the profits that borrowers can make with their small businesses? Apparently not. And they're not very sensitive to interest rates, so that means that interest rates can be pretty high to support control costs and other costs. So now the question is, there is a risk that these high interest rates increase the risk of selection. And if that was the case, then we could have this multiplying effect that would prevent the institutions from lending money. So how can we study that, and how can we make a distinction between moral disadvantage or anti-selection? Well, if this could be observed by the bank, this would no longer a problem. So what we're trying to observe is to observe something which is not observed, which cannot be observed. So Jonathan Zinman and Dean Carlin worked out an experiment, and the experimental design is based on randomization, as I explained, for interest rates. So first question is, we know that those who offered a high offering tend to borrow slightly less than the others, but would they pay back less if they borrowed at such a high rate? Are they tempted not to pay back? Well, yes, they do. They are tempted. And the number or the proportion of non-paid back credits at maturity is modified. But this difference could be due to more disadvantage or anti-selection. What's anti-selection? It's people accepted to borrow at such a rate, but had already decided not to pay back. And for moral disadvantage, it's those who'd accepted who intended to pay back, but at one stage the weight of reimbursement was too high vis-à-vis their profitability and couldn't pay back. So this is everything we talked about since the first inaugural lecture. How can we make a distinction between those two effects? And how can we see how interest rates have an effect on the decision to pay back? And that's our usual issue, but we've only addressed it through the treatment or processing standpoint, whereas here we'd like also to sort it out through the selection position. So here the example is very interesting. People get a letter. They read the letter and they move to the bank because they want to borrow money. They start talking with the agent, and sometimes the computer says, oh, well, the interest will be lower. So for those coming in with a high interest rate, sometimes the computer makes a decision to offer them a lower interest rate. So we have two customers here. They receive different offerings. One accepted to borrow at a high interest rate. The other one has accepted to borrow at a low interest rate. But at the end of the day, they get exactly the same rate because the computer worked it out in such a way that they get the same rate. And when we compare their reaction, we can discover the effect of anti-selection. There is no treatment, a processing effect, but there is just a selection effect. Second thing, we can then compare two people who both walked with a high interest rate. One of them kept the high interest rate and the other was offered a lower rate. So now we have the same selection effect, so we have control over the selection part, and all we can study is the treatment effect. Third thing we can do, this treatment effect could be due either to moral disadvantage or to various difficulties people would go through. And to make a distinction here, some clients having a low interest rate offered to them are offered to keep and maintain this low rate if they actually pay back. So that's what we call dynamic incentive. I expect you will want to maintain this preferable interest rate, and to do so, I expect you're going to pay back. And the interest of doing so, that it allows to compare people who had an offer for a high interest rate and then ended up with a high interest rate or a low interest rate. And it also allows to study the anti-selection effect for those who walked in the bank with a high interest rate offered and those to whom a low interest rate had been offered. So here are the results. That's for those who had an offer for a low interest rate and actually got a low interest rate. And that's the payback rate for those who got a low interest rate but ended up with a high interest rate. The moral bias effect, low rate offered, high rate but came in with a high rate, and we can compare them with the other category, a very small difference again, but what does make a difference is to promise to people that they will keep and maintain a low interest rate. So yes, there is a problem of moral bias. We can encourage people to behave better if we promise that they will keep and maintain a more favorable rate than the one they're used to. But on the other hand, increasing interest rates does not create any moral bias or anti-selection effects. So it Sept illustrates why interest rates can be high without the market collapsing. They don't have to be high, but they can be high. But all these issues around morality bias do not just exist in the mind of economists, but they do exist in real life, and it's important to encourage people.
So this allows us to, this kind of thinking, which is a bit more abstract, as opposed to the one we used to. We've tried to show these and apply these parameters and apply them in actual experiences. Well, this is about focusing on the subject matter related to the moral uncertainty. So the issue with the related to microcredit and how does it work has got, actually integrates and this element of uncertainty. First of all, we only grant money or lend money out to women. There's a weekly logbook for, so weekly, the money is weekly repaid. The loans is applied or is offered to a group of anything between 5 to 10 women. There's a system whereby people meet up on a weekly basis in order to exchange, to discuss matters related to rates and their businesses. And then in the beginning, we're talking very small loans increasing over time. This uses a lot of staff on low income, working with high bonus rates, if they can attract people to come in, working with them. So there's this strong pooling effect. So this actually ends up costing a lot of money. Interest rates are very high. We're talking 20% or over. Often, so that is actually what we were. That is exactly what we were saying. Interest rates can be high without the market collapsing. So, in this forthcoming part, I'm going to stress the key elements to understand how microcredit actually functions or works. This is what has been discussed at length back in the 80s, notably in very theoretical ways. And then there's a whole group of researchers and institutions operating in the microcredit sectors have worked together in order to identify what could actually work. First of all, lending money to women. Well, why are institutions lending money to women? Well, they are amongst, when talking to these institutions, there are three reasons to be put forward. Well, first of all, they are intrinsically more reliable, they are more subject to shame, so they are better clients. There's a social purpose as well. Lending money to women actually increases their decisional powers within the households, which is an objective in itself because it gives them more power within their own households. And then it's likely that this will improve the standard of living of everyone in the household. So there's a social objectives in lending to women. And what we hear from microfinancing businesses, because women can have more, because they have no other access to credit, as opposed to men, their profitability related to capital and the ROE is higher. So they are basically more capable to better reimburse, so their profitability is deemed higher. So this is an act of faith from the part of microcredit institutions. Is this correct? How does it translate in reality? On the first point, we haven't got any experience on this particular matter. We're going to regard this as true, de facto. Let's say. Second point, we'll come back to this, to that one, when talking about the impact of microcredit on the life of household. And third point is in terms of profitability, is capital profitability or return on investment higher for women as opposed to men. So in Sri Lanka, for instance, we gave money as part of an experiment both to women and men. Let's check out the results. This is the profitability of capital for men and women, so the same again as before. Quite a big leap between no grant to $10,000 grants, no much change here, and for women, no effect whatsoever. Basically, we grant subsidies in this sample here. For the time being, there's only one experiment, and in this sample, the profitability for women is 0. Why is this? Why is that? When talking about this and focusing on this sample, first of all, money was not actually put in the business. That actually explains. This accounts for this non-profitability. Basically, the money was invested in the family, and this actually does not translate in an increase of profitability here. The capital yield for men and women is about the same when we focus on the same type of businesses. When we look into what's happening between men and women, the capital yields is actually greatly reduced. So this is an extremely provocative result which we could replicate in other areas in order to check its validity. But we can't say that it actually comes from nowhere or without any particular reasons. So we have other examples of capital yields. The Christopher Euder study has demonstrated that in Burkina Faso, the farmland-related productivity is greater between for women as opposed to men. So the fact that although men and women are actually within the same households or belong to the same households, the fact that they can have activities whose yield is extremely different across the board means that the household is not operating or does not function properly. So if things were okay, if things were actually working well, I mean, people could, in this study, basically could use the money as they wished. So if I gave $100 with a lower capital yield, in the case of women, then I could give this money, I could hand this money out to men. Same goes for production and capital yield for men. Being lesser than women, well, we could actually rebalance things, but things are not actually balanced in the best possible way within these households, and this translates conflict, disputes between families, where it is important for everyone to remain in control of over some of the resources, although the overall size overall sum of money involved is lesser. Then this would actually be a matter of actually controlling. Then, for women, this is not about maximizing profitability, but purposes can be very different. I've spent much time interviewing small entrepreneurs, small enterprises in many countries, and very often we hear that the small enterprises involving women is not really about becoming a larger businesses, a larger enterprise one day, as opposed to actually being a way for women to work whilst looking after their children. So this is obviously this is not something that people look after really seriously in terms of businesses. And then there is a point that we need to bear in mind whenever we need to assess our credit and impact assessment. There are many small businesses in poor countries that actually, and the intention really is not going to be about growing these businesses into large entities. It's just because they haven't managed to find another job, they're not able to, or because women need to look after their children and they can't actually work within factories. So obviously we're not too sure whether this is in fact efficient, whether lending money to women is an efficient way of doing things. We don't quite know whether lending out money to women is not really something that supports credit and access to the credit market. So what is essential to repayment is about working out the best possible lead times or monthly repayments. So if you use money for a cow and this cow produces veals, well, and whether you can talk about a shorter cycle, a shorter business cycle, this is going to have a bearing on the actual money being reimbursed. So if we talk about 100 to 100 rupees needing to be repaid on a weekly basis, this will have a different impact in terms of maybe in comparison with a scenario whereby people will have to repay money on a monthly basis. So basically the repayment schedule might not match the actual weekly pattern or monthly pattern. So what is the impact of weekly repayment? So in order to look into this, Erika Field and Rohini Band worked on VWS, a large microfinancing business in India. Basically, the intent was about knowing what was the impact of this weekly repayment pattern. So they worked with 100 groups, and they were told, basically, they told the people whether once the groups were set up, they would then tell people whether these will be the money will be repaid on a weekly basis, on a monthly basis.